Hey, welcome back. This is video 3 in Deal Clarity's foundational series, and it's an introduction to our educational series, Understanding the Language and Numbers Behind Every Deal. It contains terminology that is used in deal analysis. This series includes real estate terms and financial concepts that are used in deal analysis and that investors encounter every day. We'll break them down topic by topic. Whether you're new to investing or expanding your knowledge, my goal with this series is to help you understand the language and the numbers so you can use them wisely to make smarter decisions about your investments. So, today's topic is debt service coverage ratio, DSCR. Yeah, it's a goodie. So let's get started. Most investors think DSCR is just one simple formula. They think the deal is either a yes or a no. But if you're crossing over from residential investing into buying commercial properties or businesses, using the wrong definition of income can get you left all the way out of the bank. Let me show you what I mean. Okay, to get this started, let's look at how DSCR is calculated. The DSCR is calculated by dividing the net operating income, the NOI, by the total annual debt service. This is the commercial method. Or by dividing the monthly gross market rent by the PITIA. This is the residential method. Residential as in 1 to 4 units, 1 to 4, like the duplex, triplex, and the fourplex. Or by dividing the NOI plus personal income by the property debt plus personal debt. This is the global method. Okay? You can leave something in the comments, make a comment if this is one you hadn't heard of before. Or there's another one. Start with net income, add back interest, the taxes, depreciation, and amortization to get EBITDA. Then divide by the total annual principal and interest obligations. Okay? And that is the EBITDA method. EBITDA. Okay, EBITDA. Yeah, there we go. That's it. EBITDA. Let's just call this a preview. Yeah. Okay, you were just introduced to the 4 methods of calculating DSCR, and now I'm going to take you through the method, give you the formula, tell you which entities use it and why they use it. And as we go further into this, I'll do this for each method. Then we'll do the calculation and do this for, again, each method so you can see how they differ. And we'll finish this with one property using all 4 methods against one property. So you can see the impact that each method has, and you can determine which method is better for what you want to accomplish. But we'll get into all that later. I'll give you the pros and cons that go with it too. So this is the first one. traditional net operating income. This is the NOI method. This is the commercial real estate method. The formula is DSCR equals net operating income divided by total debt service. And the entities that use this method are commercial banks and insurance companies. And commercial banks covers a lot of territory. Okay. Now, the reason banks and insurance companies focus on this method is because they focus on stabilized, cash flowing commercial real estate, such as strip malls, office buildings, large apartments, etc. And the method is used to ensure the property can generate a safety buffer over the mortgage. They want to make sure that the property can generate enough income to pay for itself. And if it can't, then the loaner's package just doesn't go anywhere. It's rejected. Okay? It just does not happen. All right, so we will move on to the next one. Okay, DSCR, method number 2, Global DSCR. And I'm going to be reading this so you can listen or you can read along with me. DSCR formula is DSCR equals business cash flow plus personal income minus personal living expenses divided by business debt service plus personal debt service. Now, who uses this formula or this method? This formula, actually, community banks, credit unions, and small business administration lenders. And the reason why they use this method is that they lend to small to medium-sized businesses or closely held entities where the owner and the business are financially intertwined. They aren't keeping their finances separate. So it prevents borrowers from hiding weak business revenue behind strong personal assets or reverse that, from hiding weak personal assets behind a strong business revenue. So everything is in the mix. There are no secrets. That is the global DSCR method. Small business administration gets in your business. Okay? Moving right along. Okay, residential DSCR method. 1 to 4 units of investment property. The golden rule is no owner occupied. Okay? So that 1 is a single family residence, but the investor cannot live there. These are investment properties only. So that's a single family, duplex, triplex, and the quad. Okay, formula. DSCR equals gross monthly rental income divided by gross monthly property debt, the PITIA. And this formula or this method is used by non-QM, non-qualified mortgage lenders, private money entities, and portfolio lenders. Private money entity, hard money lenders, private money lenders. These entities cater to real estate scaling. They treat the property as a separate business unit, and this method allows investor LLC entities to acquire properties at a faster rate. This is a B2B transaction, as I just read, as you can see, an isolated business unit, and the lender is a business, so it is a business to business transaction. And something that you need to know, if you don't know already, lending institutions, the banks, and other entities are regulated. They are policed on how they do business, who they do business with. No bad guys. Can't do business with bad guys, but no discrimination. Okay, figure that one out. Now, even though they are regulated, their products are not. So they can make up a product to satisfy you. If they want your business, they can put a product together that will suit you, customized to suit you. If you didn't know that, remember that. Okay? You can get a product just the way you want it. If they want your business enough, badly enough, they will do that. Just something I thought you needed to know, because I didn't know, and I'm learning, just like you. I don't care where you are in this journey. Every day you are learning. Okay? So, moving right along. Number 4 is the EBITDA method. That one is fun to pronounce. The E is pronounced E, the BIT is pronounced bit, and DA is duh. E, bit, duh. So if I was acting strange before trying to get that together, that's why. Okay, the formula is DSCR equals EBITDA, or the adjusted EBITDA, divided by interest plus the results of principal payments divided by 1 minus the tax rate. And that's just written out. You should see it for real, which you will later. It's a very interesting formula. I saw that the first time. It's like, what the heck? Okay. Somebody please explain this to me. So it's used by corporate lenders, investment banks, and commercial and industrial loan departments. Why do they use it? They use EBITDA to see how much money the core business actually makes, ignoring differences in debt levels, on paper accounting write-offs like depreciation and amortization, and local tax rates. Those last two things, the depreciation and the local tax rates, can cause, how do they say, distortions, because the tax rate in Florida is going to be different than the tax rate in California. All right, so we will get more into that as we move along, as we get into the calculation. It will be easier to explain it when you can see some numbers and see how the formula is written out. But those are the 4 methods, and now it's time to put them to work. Let you see how this works. Okay, so I'll see you on the next one. We are going to start with give you the property profile, and this is the property profile. This is the property we'll be using for all 4 methods. It is a 4-unit quadplex, fourplex, with a total monthly rent of $8,000. That's $2,000 per per unit, and that's $96,000 a year. The monthly property operating expenses, $2,500 in taxes, insurance, utilities, and maintenance, which is $30,000 a year. The proposed mortgage, the interest is $1,000 a month, and that is principal of $2,000 per month. Okay, principal is $2,000 a month. The interest is $1,000 a month. So the monthly payment is $3,000. The P&I is $3,000, which annualized is $36,000 a year. Total monthly housing bill, the PITIA, $3,000 mortgage, taxes and insurance, $4,000 a month. That equals $4,000 a month. Okay, so we're adding the mortgage plus the taxes and insurance to get the 4. Okay, that is the profile of the property. The quadplex, and 8,000 a month, 2,000 per unit, 96 a year. Monthly operating expenses, 30 a year. Okay, so let's plug these numbers in. Okay, this is the first method, net operating income, the commercial real estate approach. This is the standard traditional method used by commercial real estate lenders, and it's used to evaluate the cash flow potential of a property itself, independent of tax situation. So the formula is DSCR equals NOI divided by total debt service. In order to get started with this, we need to calculate the NOI. And we do that by calculating your gross rental income, subtracting the vacancy and credit losses to get the effective gross income. And the effective gross income minus operating expenses, which is the property taxes, insurance, and maintenance, equals NOI. The annual principal plus interest payment equals the total debt service. Now, your operating expenses, you see a list there? Those are the operating expenses. That's property management, property taxes, building insurance, repair and maintenance, utilities, janitorial, landscaping, legal and accounting fees, marketing, and advertising. All that is considered operating expenses. So as I said a minute ago, you take the effective gross income, subtract the operating expenses, and that gives you the NOI. And now that you have the NOI, you're going to divide that by the total debt service. Your principal. All right, you've done the math, and now you have your NOI. Your annual NOI, which is 96,000 rent, minus 30,000 in expenses equals 66,000. Your NOI is 66,000, and that is divided by the annual mortgage debt, which is 36. You see the formula, see it printed out with the numbers plugged in, and when you do the math, your DSCR is 1.83x. That's $1.83 that you have, that the building generates for every dollar that is owed on the loan. So the commercial bank looks at it annually and sees a 1.83x ratio. The property independently covers its own mortgage 1.83 times with a clean 83% cushion, which is a good thing. So they're happy with it. Okay? It's a lot different when you can see the formula next to the numbers. It makes a difference. So that's the way that one works. That is commercial. And we'll move on to the next one. This is the global method. The lens that we're looking through is a community bank lending to a local mom and pop investor. The bank says the building looks good, but what if a unit goes vacant? We need to look at the property and the owner's personal finances. Remember, global throws everything into the mix. It's the business income plus personal income, business debt plus personal debt. So let's look at this. The owner has a day job making $70,000 a year, but carries $40,000 a year in personal mortgage and a car debt. Using the global method, 66,000 property NOI plus 70,000 from his job. That's 136,000. Global debt, 36,000 property mortgage, 40,000 in personal debt. So that brings it to 76,000 in global debt. Okay, you see the formula, global income divided by global debt with the numbers plugged in. 136,000 divided by 76,000. The DSCR is 1.79x, meaning that using this method, the lender sees that the property is generating $1.79 for each dollar that is owed in mortgage payments. And by throwing the owner's personal life into the mix, the ratio comes in at 1.79x. So it has its good and bad sides, but we'll get into that when we look at the pros and cons. That's the global method. Now we're going to look at the residential DSCR. And you'll remember that residential is strictly for investment purposes. This is 1 to 4 units. Strictly investment purposes. The lens that we're looking through is a private non-QM lender. Non-QM means non-qualifying mortgage. Non-qualified mortgage lender. Evaluating a solo real estate investor buying the quadplex in an LLC. This is the one that I said earlier was a B2B transaction. They look only at monthly property cash flow. So since they are focusing only on the monthly property cash flow, if it's not making enough, the deal won't go through. The loan just won't happen. So let's take a look at the math. Gross monthly rent divided by monthly PITIA. So that's 8,000 divided by 4,000. That's an easy 2.0. To this lender, property is a slam dunk. It generates exactly 2 times its monthly housing bill. The investor's personal income is completely ignored. Okay, that's why this is so popular. That's why everyone wants to use it. It leaves everything, all your personal stuff out. But that can be a bad thing. Okay, it's that can be a bad thing. We'll look at that later. Okay, the next one. I know I said we'd look at this later, but I think it would probably be better to go ahead and do it now so you have both examples to look at, to compare, and to remind you that you need to give this serious consideration. This is the modified residential method. It's modified because a 25% investor haircut is applied. And the reason for this is because some investors realize that, not taking any expenses into consideration is rather risky. Okay? So you're just looking at the cash flow and not thinking about expenses at all, like they don't exist. That's not the real world. Okay, so they apply a 25% investor haircut. So using the same figures, the math is the 8,000, which is the gross rent, over 4,000, which is the PITIA. Now, that 25% haircut uh, times the gross rent, which is going to be the 8,000 times 0.75, is going to give you 6,000. All right. So we put that 6,000 over the 4,000. It's $6,000 divided by 4,000. And that gives you a modified DSCR of 1.50. Still healthy, but you've got some room in there. Okay, you're not fooling yourself. It's more realistic. Let's just put it that way. It's more realistic. It's a low risk deal for the investor. All right, so keep that in mind when you're thinking about using the residential method. Add that 25% in there. Protect yourself. This is number 4, and the lens that we're looking through is a massive corporate fund or institutional syndication company buying the fourplex alongside a portfolio of other businesses. The corporate lender evaluates them under business tax rules. Now, the added content, 25% tax rate. This is the method that has two fractions, a fraction within a fraction. Okay? So the top half, this is the EBITDA. The property's raw annual operation profit is 66,000. The denominator, this is the adjusted debt. The interest is 12,000 plus the grossed up principal. And this is where the other fraction comes in. 24,000 divided by 1 minus 0.25. That's that 25%. You take that 0.25, multiply it by 100. That's when you get your percentage. Okay, so it's 1 minus 0.25, which means that that 24 will be divided by 0.75. And when you divide 24,000 by 0.75, you end up with 32,000. 32,000 plus 12,000 equals 44,000. And grossed up means that some of the expenses, excessive expenses, were added back to the total to show the business's true profit. These are expenses that are not normal, they're not everyday expenses. such as owner's compensation. Say the owner pays himself a lot of money. So they use a third party manager salary as the gauge, and anything over what that salary is added back. Personal expenses that are run through the business, those are added back. One-time non-recurring costs are added back. These are not everyday expenses, so they're added back into the total. So it's 12,000, the bottom half, the denominator, numerator. The 12,000 plus 32,000, which is what you get when the 24,000 is divided by 0.75, equals 44,000. So we are dividing the 66,000 by 44,000. And the number you get there, that gives you 1.50. So the DSR using this method is 1.50. Corporations must pay principal out of post-tax profits. So the lender adjusts the math. The ratio drops to 1.5 because the business has to earn extra money to pay the IRS before it can pay down the loan balance. That's cute. Don't you think that's cute? We have to make an adjustment here in our calculations because you have to pay the IRS first. So we're going to play with this a little bit so you can pay them and then you can pay your loan balance. Okay. That's how one property can have 4 different DSCR ratios. It all depends on the method used to do the necessary math. And honestly, as you saw, if you were paying attention to this, I mean really paying attention, it's not the math. It's what each entity calls income. Okay? Residential lender 2.0. They looked at the money and threw other stuff away. Commercial lender 1.83. Again, look at some stuff and throw the rest of it away. Global lender, oh, we'll take everything. We'll look at all of it. Corporate lender, we'll add some back. So it just depends on what they call income. Now, you as an investor are going to, it would be to your benefit to know these different methods and know what your lender is going to, which method they use, so you know how to put your loan package together. The next few pages are self-explanatory, ideal DSCR ratios by method. Yes, this was a rather long video, but in the process of going through all those methods, I hope you got the information that you needed. I'd like you to, or I'd appreciate it very much if you would leave a comment. Tell me your thoughts about it, whether you thought it was too detailed, if like the fact that it was detailed, if it helped you any, if there was, which method you were surprised by, didn't know anything about, hadn't heard of it before, and if you felt like you learned anything, because I know I did while I was explaining it to you, I was learning. It was being reinforced. So this was a learning experience for both of us. For both of us. So if you enjoyed this and want to continue on this journey with me, please, subscribe, and I will let you know when the next video is coming. I'm building the foundational resource. So, and as I said, I'm learning. So there will be videos coming, definitely. That's a definite, okay? So I hope that you do decide to join me. Meanwhile, take care and continue to learn, master the terminology, understand the numbers, and you'll see the deals become much easier to evaluate. Every successful investor started by learning the language of real estate. Remember that. Take care. Be blessed.